Very good. Good afternoon, everyone. Let's give just 1 minute so that everybody is all set. I guess we can make a start. So welcome everyone to this webinar about the future of working capital optimization. And I guess if you're here today is that you're all interested about working capital topic and how to bring it to the next level. So Oliver, Daniel, and myself are very passionate about this topic, and we hope to give you some tips and how to bring your working capital initiatives to the next level, starting right after this call. So before we jump into the introduction, I just would like to remind you very quickly some housekeeping information. So this session will be recorded, and the presentation as well will be shared after. And please make sure that you write down your question through the Q&A section that you should have if you're using the app or the web version of the Zoom. So maybe we can start with the introduction, and I have the immense pleasure to have Oliver Belin from Calculum as analytics platform, really important in the working capital industry, and also Daniel Bischof as sales director of CRX Markets and one of the many execution technology platforms for working capital. So maybe Olivier, you want to start with your introduction?
Yeah, sure. So again, from my side, welcome everybody. I'm super happy to have this session today. I'm one of the co-founders of Calculum, a company based here in Miami, but actually I'm originally from Switzerland, Zurich, and I have a lot of, 15 years experience in helping organizations improve their working capital, and also in the receivables financing and supply chain finance solution space. And I'm happy to give you today an overview about the latest and greatest in this field, and also a short demo of our platform.
Thank you, Oliver, and Daniel.
Perfect. Hello, everybody. It's a pleasure to be here today. My name is Daniel. I'm a sales director with CRX Markets. Joined the company in 2016. Before that, I've always been in the trade finance working capital space. Used to work at Deutsche Bank, and here at CRX Markets, we are kind of the execution platform technology provider when it comes to the connection between corporations who seek for working capital finance solutions, and on the other hand side, the financing partners who provide liquidity. And very much looking forward to the discussion with Pierre-Louis and Oliver today.
Very nice. Thank you, Daniel. So from my side, I'm Pierre-Louis Frugier. I'm part of PwC Switzerland. I'm based in Geneva, and I'm working on the treasury consulting practice at PwC. So we support companies for any topics related to treasury, being processes, systems. And thanks to my experience as manager of reverse factoring program and account receivable financing, I also support on different working capital financing initiatives for our client. So now that we've done the introduction, you may wonder, as we should have many treasures on this webinar today. What can you get in this next 50 minutes of webinar? So we have here an agenda, and I'll go really quickly through it, right? But the first point would be to get you to understand the working capital landscape, challenges and opportunities. The second one would be to give you some success factors, right, that we see also from use cases. And third is all the trends for the future and the development that we will present to you from Calculum and CRX side. And then really a call for action, right? That would be our conclusion of this 50 minutes about how to get to the next level. I would like to keep 10 to 15 minutes for Q&A at the end. So please make sure you save them for the end. So if we jump right into the first topic, I would like to start with this slide, and the aim is really to show you why now it's the time to look into working capital optimization. And for that, I will start, of course, with the economic context that you all know and the competitive landscape that is driving this initiative and this idea of working capital optimization. And it's due mainly to four reasons that you can see on the left-hand side on the slide. And the first one being the pressure on cash flow management. And I will mention here that we are working with many different companies to optimize their cash flow reporting, cash flow forecasting exercise, so that helps you to make the right decisions. So we see that as a key reason and a key factor. The second one is, of course, the rising interest rates and the lending squeeze that we all face in the economy. The third one is related to the global supply chain disruption and the inventory instability that is draining a lot of cash for many companies across industries. And the fourth one is really the focus on efficiency across different functions. But here today we will focus on finance and operation. So these four factors from today's environment are leading companies to improve their behavior in terms of cash management. One important figure here in the middle of this slide is really that for most of the companies, we see an opportunity to reduce working capital by 15 to 30%. And we wanted to, let's say, confirm that with our PwC Global Treasury Survey, where basically 68 of the CFOs who respond to the survey confirm that working capital is a top priority for them. And on the other side, we also asked the treasurers, and 52% of them considered working capital as being an additional responsibility of the treasury team. And why I'm telling you this is because we are strong believers that Treasury has a role to play in working capital optimization, and working capital can be added, let's say, to the strategic circle of Treasury that we have designed here on the right-hand side of the slide. So along with the cash forecasting and the bank liquidity techniques, working capital can be also in this circle. And that will bring of course, different topics around technology and organization, but Treasury can be the leader of the working capital initiatives and really drive and support and coordinate all the different departments. So maybe let me pause here, and I don't know, Oliver or Daniel, if you would like to add anything on this.
Yeah, maybe I just saw, I guess some of the audience is part of the European Association for Corporate Treasury. They just released also a very large surveys among treasurers in Europe, and they see that the current focus in terms of optimizing working capital is payment terms, and improving the cash-to-cash cycle. Obviously, the key driver, everybody knows, is the rising interest rates. So borrowing money is not cheap anymore. So everybody, we see it across different industries, across different regions. Everybody's looking at their own supply chain and optimizing payment terms. And the other thing I want to highlight, there was another report this year from a company called Intrum on the European payment landscape. And it's quite interesting that they found out that there's an increasing trend from 2021 to this year where they spoke with suppliers, and suppliers mentioned that they're being more and more approached by large organizations and also mid-sized companies to review their payment terms, basically to optimize their payment terms. And this reflects the first survey from the European Association for Corporate Treasury. And happy to share that maybe after the webinar to the audience.
And maybe also to add to you what you guys said, I think also from our perspective, we see like a clear driver that in every treasury organization, working capital is a topic somehow, and there are corporations who already have an existing supply chain finance program, for example, in place. Others who are looking at it for the first time. I mean, after years of cheap liquidity, so to say, this becomes now more and more relevant. And from our perspective, it's super nice to see that technology becomes a more and more important driver, as especially organizations who might already have a program with a single bank or so in place, they now see the need that they want to push these supply chain finance and payment term initiatives a bit more down the supply chain to also lower, to also smaller suppliers. And we see especially existing traditional bank programs, they very much stick to only the very kind of high volume suppliers to the very large suppliers. And technology now enables also to tackle the long tail of the supply chain. And this is what we see as a very positive development, that now all the different technology solutions get a bit more drive by means of automation and digitalization.
Indeed, automation and data management is something we're gonna discuss here today. But before we jump into this, so we would like to also share with you, and we kind of introduce it, but some key success factors, right, that we see, and the working model for your working capital optimization initiative, let's say, that we are thinking is bringing like people like us, right, from analytics platform, technology platforms, but also advisory services to really drive efficiently all of those success factors that we're gonna present to you now. These are focused on supply chain finance, right? But they can be some of them quite replicated to any working capital financing initiatives. Oliver, would you like to start with this one? I think you're on mute.
Yes, so maybe there will be a difference of perspective from some of you in the audience. So I believe some of you who have already implemented such financing solution with their supply chain, with their suppliers, they will agree on that. And some of you which are early in the journey, maybe looking at this type of programs, they will be maybe surprised. So this is based on many years of experience. And you see, and we don't go to each point, but clearly, a lot of companies at the beginning, they always think pricing is the most important, correct? They always believe that pricing will make the difference in them as a buying organization, improving their payment terms, improving their working capital. However, clearly, it shows that a difference of a few basis points will really not change the needle or change the behavior of suppliers, which will trade their receivables to get paid earlier, or for sure not make any difference in terms of the success of negotiating better payment terms for the buyer. And I guess Daniel and Pierre, you agreed on that, right? Based on your experience with your corporate clients.
Yeah, so 100%. And I think, like Oliver, we were discussing this in the preparation of this webinar. We were discussing this quite actively. I really have to say, like, you know, having tech players like you, analysis of spend file is an easy task. But what I think is really challenging from a technology provider, from an execution perspective, and this is what I would like to highlight, is really the alignment of management. So bringing all the stakeholders to the table, don't forget anybody, involve these stakeholders quite early onwards. And I think Pierre-Louis and his organization can also help in this alignment phase quite a lot. But I think this is really also one of the key success factors. But all of the above mentioned, I 100% agree.
Yeah, no, I can only echo what you have said. And although, Daniel, I will have to say the analysis is not always simple, but it can be complex. I'll share maybe some examples later. But on this key success factor, indeed, I think the communication is key. And the earlier you onboard all your parties, the better it is. And also training, right? Right at the beginning, right? When you do design and selection, you make sure you train your teams from finance or for procurement on this new supply chain finance program that you are thinking about. And talking about supply chain finance and success cases, I think, Daniel, you will have concrete examples to share with us today.
Yes, so happy to do so. So these are some, let's call it real life examples we see on our platform in the supply chain finance space. This is all like public knowledge. And if there's more interest to learn in detail about these cases, happy to take this up afterwards. I just want to highlight, so why are companies introducing supply chain finance? Why have they introduced this? And I think the first case is Nestle. So here, I think it's very much straightforward. They wanted, or they had the long-term strategy to improve their working capital in order to, improve capital employed and all these things. And this is why they introduced such a strategic tool. And what I very much like about this in the last years is that next to improving working capital, they also put like another angle to it, which was in the field of sustainable supply chain finance. Yeah. So what they are also doing is they incentivize suppliers when they comply with certain sustainability goals, sustainability targets, sustainability ratings. They incentivize these suppliers and offer them more attractive financing conditions, as an example. And this is like super nice to see that on the one hand side, you're optimizing financial KPIs. On the other hand side, you also work together with your suppliers in order to achieve your own ESG goals, your sustainability goals. And this is a very nice example of how you can combine these two initiatives. Another one in the chemical industry, this was a scenario we've seen roughly a year ago, where we could see like a crazy increase in energy prices. And here we had situations where chemical industry, it's like super energy heavy, where they were facing situations that the demand of liquidity was increasing dramatically. Yeah. And thinking back of a situation that this company would only have like one bank, financing their supply chain finance program, they were kind of lucky because they set up very early on a multi-bank supply chain finance project, which allowed them to really very quickly add additional liquidity sources to their supply chain finance program in order to really fulfill this demand of increased liquidity in very, very volatile times, and to react very, very quickly. Another recent example, and this also already Oliver mentioned this in the beginning, is we are currently seeing scenarios that suppliers are faced by, increased financing rates, increased liquidity costs. And here's a very nice scenario of BRP Rotax. It's an Austrian-Canadian company, and they got approached by their supplier base, who said basically, we want to reduce payment terms. Of course, you don't want to do this as a company, and it's a very challenging situation for you, but especially for the suppliers. And this is why this company decided to introduce a supply chain finance program, which allowed them to even slightly improve the payment terms with certain suppliers, but in the same situation to offer them an early payment tool so that they could get paid even earlier than they get paid today. Yeah? So this was here a clear win-win situation in times of inflation, in times of increased financing costs. And this is like in supply chain finance, we're always talking about a win-win situation between buyer and supplier. So this is really one of these very nice examples here.
Oh, exactly, and thank you, Daniel, for sharing this. And I guess it could be also a win-win situation between Treasury and your operations, right? Because you mentioned suppliers asking to reduce their payment terms, but also interest rates going up, right? So how do you find a solution for cash? So supply chain finance could be one, of course. And I guess with that, we can move on. And you mentioned some of the trends, right, that we see here. So here we prepared a slide of trends and future development that we see in supply chain finance. I don't know, Oliver, would you like to start with one that would resonate the most for you? You're on mute, Oliver.
There are many. We try to have all of them here, but let's maybe pick one. What is interesting is the first on the top, mid-market. So I would say this type of financing solutions, they are based over 20 years now. I would say the top 50 retailers, everyone has this type of financing solutions in place, every Fortune 500 company. What is interesting now, obviously these companies brought their suppliers on board in these financing solutions. And now we see during the last year that these large suppliers are setting up their own programs, and it goes down the food chain. So what we see now, especially now with technology and also new capital market funders and banks, that there's more and more going on in the mid-market. So companies which are smaller, I would say 1 billion and below, which are setting up their own programs with their suppliers. And this is a great development which we see.
For you, Daniel?
Yeah, so for me, it's really like in the past, we've seen a lot of really bilateral supply chain finance arrangements. So if you were doing like factoring in Germany, you were doing it with one factoring company, and supply chain finance in the US and in Europe also with 2 different other providers. So today we're really seeing a concentration of these activities, and corporations thinking more in a dimension of multi-program settings. So they want to have one access, and they want to trade different currencies. They want to be able to trade in different countries, in different jurisdictions. And I think this is even next level. They want to also do or get technology and do trades across different products in the working capital finance space. So this in combination with multi-bank capabilities is really one of the big trends we are seeing, when also companies who have existing setups are kind of reinventing these setups and thinking it more like for the future and more sustainable.
Yeah, no, indeed, Daniel. And you mentioned the different supply chain finance programs, right? Bilateral supply chain finance programs in different countries, as you said. And to me, on this slide, I will focus on data. And also mostly on the structure of your data, right? Because similar to what you explained, Daniel, I worked with different companies, and we spent a good amount of time to get the right data for the good analysis that would be the foundation of your next supply chain finance program. And what I mean by this is that the data was spread in different ERPs, right? Depending on the region, maybe in the country. And then it took a lot of time to get the right data owners and make sure that we understand correctly the data. So once, for instance, you have the complexity of your data, it's really powerful, for instance, to partner with a company like Calculum, because you're able to, for instance, compare the payment terms with your competitors or peers. And I guess, Oliver, you will be the one to present it the best, right? What Calculum is doing. So maybe you can go and present your platform, Ada.
Sure. Let me share my screen quickly. So I would say, I mean, obviously everybody says they have something new, but I would really say in this market, this is something fresh solution, which is purely focusing on data, as Pierre-Louis mentioned, and leveraging AI. So what the platform does, it's analyzing all suppliers and finding patterns and finding ways to optimize working capital, or can also be discounts, okay, both sides. And obviously the first step is you need to find the suppliers, you have to match them. So usually we have a matching rate of above 85%, especially with suppliers, because supply chains are global in nature. So suppliers in emerging markets, which are private companies, the matching rate is pretty high. And as a result, the first step in this journey is matching it, providing a confidence score, and cleaning all these supplier profiles. Then the other part is then to show to clients, to treasury and procurement, where to concentrate the efforts, how much leverage you have. So basically comparing your spend versus the total sales of the suppliers. So how much your spend is representing in terms of total sales of the suppliers, and in looking at multiple different ways to slice and dice the data to really see and create a plan where you should concentrate and how much you can achieve. And now if you look in terms of supply chain finance, you can simulate very easily a program with a bank or with a technology platform, or just by looking where you stand with your payment terms versus your peers and your competitors. And this is, by the way, a demo account. So this example, you have the contractual terms. You see the client, this buying organization pays on time. The opportunity, which is calculated, is moving the terms to 92, looking at each single supplier and seeing where you stand versus your competitors. And then what is the expected, so how many suppliers will agree on these payment terms, and then how much free cash flow you leave on the table by not being aligned with the market. And there's many, many different further analysis where you can see, okay, what is the probability of success that this supplier will say yes? What is the biggest impact on you as a buyer here in terms of cash flow? And then you can set up a clear plan. You can see, okay, I want to start with box 2 and 4, and then you see your suppliers, so you can see where are the low-hanging fruits. Now, the opportunity, as we all know, means nothing if you don't have a plan and you can execute another plan. So, and we also know from our experience that Treasury is looking to improve working capital, but they have to work in conjunction with the procurement team. And it's very, very important, as I think Daniel mentioned, the alignment of top management, but also the alignment between procurement and finance, that they work together. So this module allows really to set together a plan, to agree on the timeline, and to measure the execution of procurement negotiating these terms. And quickly, last thing I want to show you is, obviously, all this data is available on each single supplier. Again, empowering procurement with all the right data. So, for example, showing these suppliers belong to the same parent. So finding the parent company and telling you what are the different payment terms you're using, providing details on industry and commodity, providing very important information on the credit risk, credit rating of these suppliers, the expected funding cost, your leverage, ESG ratings, where we work with different providers and minority-owned business information. And then key is providing in the client's view all this information as a summary for procurement to have all the arguments ready to be successful in the negotiation. And to make it even easier, having a script which goes step by step, telling you where you stand and what argumentation you should use to convince the supplier to agree to these new terms.
You know what, Oliver, just to add to this, what I really like about it is also, you know, what we are sometimes lacking is that the organizations need more confidence. Yeah. So they need confidence that this initiative will be successful. It's in the first instance, it's Treasury very often, then also very, very quickly procurement. And this tool gives you like also a very much broader view, also from outside in and other data sources, that gives you confidence when you're creating the business plan, when you're creating the likelihood of suppliers joining. And I think it's really helping procurement and treasury organizations to push these initiatives inside an organization.
Yes, you know, I agree, and it's just important also to, I think in one of the trends, you know, was regulation. It's also important that you don't stretch your terms too far, correct? That you also aligned with regulations, with what the market in specific industries or commodities is used to. So, but it's also important that you are not the organization which pays everybody too early, correct? So it's just to have these standards in place where then you have a good base to negotiate better payment terms and be more competitive.
Exactly. You know, I think that's a very valid point. Daniel, you I think you wanted to present and discuss also one of the trends that we saw right in the previous page, but about the multi-funding structure. So Daniel, if you would like to go ahead.
So thanks a lot. So I mean, this is, I think, really what corporates today are looking for, and this is a solution which has no borders, yeah, no limitations, which is truly scalable. And we see many corporations, especially as, you know, it's a bit more, financing is a bit more expensive, and you don't want to rely only on one source of funding. Yeah? And this is why many corporations, they want to put the eggs in different baskets and want to get access to the broader range of relationship banks potentially on a global scale. And we offer this this technology platform where a corporation can connect its whole organization to this single platform. And on the other hand side, you know, depending on jurisdictions, on currencies, and on the supplier base, and can connect all of their relationship banks on the other side. So this means they have like one fully centralized platform and technology for their global, even not only supply chain finance, but also working capital finance activities. And I think this is really what more and more companies are doing. They're trying to get rid of these single bank, single country supply chain finance programs, but want to get more visibility on their activities, which I think is also a bit a result of future or already in place disclosure requirements for supply chain finance activities, as an example. So if you have like, I don't know, 50 supply chain finance programs globally, which is sometimes still reality, it is mega difficult for your financial statement to compile all this information from all the different sources. So this is why these central platforms where you can manage all the activities and still work with all of your relationship banks are a big trend at the moment. And this is what we at CRX Markets are supporting clients globally with.
No, indeed, Daniel. I think it's one of the most important point that we are discussing with companies today, right? Is how to have a global supply chain finance program, and especially onboarding legacy programs, but also how to make it scalable, right? If you want to onboard another territory or another big supplier, then it's important to have a centralized solution. So just conscious of time, I think I'll jump directly to how to get to the next level and how you treasurers on the call can start. And for that, we prepared this end-to-end process of let's say, a typical supply chain finance program, which we believe can be completed in a year's time. And we'll, of course, start, I think we focus quite a lot today on the detailed diagnostic. And as we said, once you want the complexity of your data, you know, partnering with Calculum will be also a key successful factor. I don't know, Oliver, if you want to add something else on this.
Yeah, look, everything comes together at the beginning, because, you know, if you don't know at the beginning what is out there, even if it makes sense to start, correct, then all the next steps are a waste of time, are useless, and will not bring you success. For example, what Daniel said, sometimes a single bank program obviously is very good if your supply chain is just regional in base or in a country, but just starting and then just adding new programs, this doesn't work. So you really have to, at the beginning, do your homework, analyze what is out there, what is the potential that these suppliers will say yes, what is your goal, what do you want to achieve, and is also your team aligned, and then setting up a proper design and following through that. So the analytics is very, very, very important, and I think most people or most companies don't spend enough time at the beginning on that. They strictly jump into the financing part and leave the first step out.
I felt you jump already in the design area, right? But indeed, I think once you've done the analysis, and we think about 2 months, we will really start with the design, and here involving, as Oliver introduced, like other departments as well, to make sure that the requirements are really set and clear for everybody. So I'm thinking here about accounting and legal departments, just to make sure that the solution, the final solution, will make sense for everybody and will work. And then the next step is really about finding the right partner for, and here we are thinking more about the execution partner, because you will need to select, is it going to be a single bank platform, as Oliver mentioned, or is it going to be a multi-structuring funding platform like Daniel presented earlier. And for that, as advisory services, we can help you to run the RFP, make sure that all the different technology provider out there answer to your requirements, and then make the assessment with you just to make sure you have the right partner. And then we will move on to the implementation phase, which we think will be about 3 months. And from my point of view, is quite easy because all of these different technology platforms are able to plug to all the different ERPs. But maybe Daniel, you will have more insights on this.
Yeah, so from our perspective, really most of the work is done a bit like in this in the prior analysis phase to the implementation, that you really make sure, okay, who are the stakeholders to involve quite early on, to have like a proper project management. And if all these things are ensured, then I think these program implementation and then also later the whole ramp up is pretty much straightforward. Yeah. So of course, I think still it is super important to have the whole organization in the same boat, to have the top management align on these initiatives, so that really everybody is also incentivized in order to make this program a success. And then we see overall the highest success rates in the implementation of a supply chain finance project.
Exactly, and I think you mentioned it, Daniel, right? But this ramp-up phase is for me really key, and here we put it as 4 months, but of course it can be reduced. But here the message is really about keep on pushing on the good communication of the supply chain finance program, train all the different stakeholders, either being internal or external, right? Finance, procurement, AP, and make sure that you onboard your suppliers quite efficiently, because that can be kind of time consuming. And one thing also we can help you with from the advisory side is also helping you with the operational bandwidth that will increase, right? Because especially at the beginning when everything needs to be set up, but you will have more and more invoices to be financed, and for the time you find the right working model, maybe we can help you on this. So that was kind of to give you an overview of the 5 milestones for the implementation of a new supply chain finance program, or upgrade the ones that you have, right? We mentioned to have a global supply chain finance while you have bilateral agreements. But we will be happy to follow up on these different steps. So maybe now we can open for questions. I don't know, Oliver and Daniel,
we have questions already.
Very nice.
So the first question is, what impact will the EU planned late payment regulation have on supply chain finance programs? If payment terms are legally limited to maximum 30 days, will it bring SCF programs to an end? So I think this is like in every discussion at the moment we're also having on conferences and so on. It's a bit the elephant in the room, but everybody is talking about it. For some of them who haven't heard about it, it is really like a plan from the EU to set limit payment terms to 30 days in Europe. We are watching this very closely. There is no decision made yet. And my experience is that, and we also heard this from all of our large clients, but also from any industry initiatives in Europe, that they are kind of trying to vote against this. Yeah, so they have arguments that, for example, the EU would be like in a disadvantage compared to other markets where you don't have such a regulation. I think still in general, you should not stretch payment terms like so long. I think this is also a development at the moment, that payment terms are brought at the moment to a reasonable level, and still supply chain finance programs are helping in this regard. But yeah, so we're watching this regulation very closely, and let's see where this is going. Might be a challenge for supply chain finance programs. Yeah. Oliver, you're on mute.
Maybe to add here, because this point is very key for us and for me, is so today, currently, there is some regulations, but the regulation clearly states that payment terms are 60 for some goods, 30 days, unless the parties, so the buyer and the supplier, agrees differently, correct? Which is perfect. let the market decide and the parties decide what they want to have in their agreements, not having the government dictate. The second point, nothing about some countries, but we know some countries in south of Europe, not even the government pays on day 30. It's impossible, correct? So I strongly believe these laws, they are in discussions right now and create a lot of questions, but they will never be implemented, because some of these laws, if they will be implemented, all these buying organizations will just shift their suppliers from Europe to outside of Europe, which will hurt much, much more the European economy and the companies in Europe than having it as it is today. And the last point, obviously, supply chain finance is the best solution for that in general, because it really helps the buyer to improve its working capital by extending payment terms, and the suppliers to get paid not on day 30, but as quickly as soon as the invoice is approved, sometimes on day 5. And this would be a perfect solution and is already in place for companies in Europe.
I'm just
So,
sorry, Daniel, but quickly on what
sure.
Oliver mentioned. I mean, in terms of process, because okay, the standard or the rule is still discussed, right? But is everybody going to be able to pay on 30 days, right? The process and different, several companies that I've seen, the approval process of the invoice and the payment process of the invoice can take a bit longer than 30 days, right? So I guess it will bring another topic about your processes and your technology around this, right? Is it a robust technology that helps you to really streamline your approval process and payment process? Maybe it's outside of supply chain finance here, but just to say that also bringing technology and advanced technology within your supply chain finance will also help your organization to maybe revisit all the different processes that you have and then have more efficient and smooth processes for payments and invoice approval. Just a thought.
Yeah.
So maybe, Oliver, another question for you, I think. Where do you get the information on the supplier payment terms and how do you monitor them? How confident can you be about their accuracy?
Yeah, so yeah, we have this question obviously a lot. So first of all, we don't have any hidden agenda. So we don't care about pushing terms or what the platform and our services. Our goal, it's all about providing the accurate information. What are the payment terms which we see in the market for this particular supplier? Now, as I said before, we have a matching rate above 85% on average for companies, multiple different industries, and we see very often always the same suppliers. However, we will never tell you, hey, this supplier is a supplier of this company and these are the payment terms, because of data security and data privacy. What the platform does, again, leveraging data analytics and AI, is every company is anonymized using its attributes. So saying like, okay, this is a small company in this industry selling this product with this credit rating. And based on all these attributes, the platform finds very similar or almost identical suppliers and then provide you information, what are the payment terms for this company. If the platform doesn't find this information in the database, then it looks at a wider scope, at similar organizations with similar characteristics, selling similar products to similar customers as yours. And then it always provides you how many companies are found and what are the average, the third quartile, maximum payment terms they out there. So and from where we get the information? We get information because we are analyzing all the time large amounts of suppliers and spend. Usually we analyze per month about 20 to 50,000 new suppliers. We already have way beyond 1.4 million suppliers, which have been analyzed, and it's growing pretty rapidly. So I hope this answer, this question came from Piotr, I see. Maybe Daniel and Pierre, I see another question, which it's one of these kind of factors where people always think this is key to the success. So one question is supply chain finance only interesting for weak suppliers with little access to funding?
Maybe I can start, Daniel, on this one, and I would say no. The short answer is no, because and I will speak from my experience, right? But it's basically usually you want to make your supply chain finance program successful, so you will look. If you start from scratch, you will look to onboard the biggest supplier, right? And really have the most amount of spend covered by a supply chain finance program. But then as you go along the way, the long tail of your spend, then indeed maybe supply chain finance is not so the best shot, let's say, for these smaller suppliers. And then you may want to push them for, I don't know, a dynamic discounting solution, for instance, that would be a bit more flexible for them. And then the first question or the second question was also about the region and the limitation of the type of suppliers and spend. I think the main question is a legal question, right? Are you able to sell the payables or the receivables to a third party? And if you are, then you don't have so many restrictions, I guess. But if you're not, then maybe you have other ways to get financing for this type of spend. I don't know, Daniel, if you want to add something on this.
No, I agree with you that it's not only interesting for weak suppliers, and because I mean supply chain finance, what is it? It's like from a supplier perspective, you have like an off-balance sheet transaction, yeah, and you can make use also of the balance sheet of one of your customers. So it's really like a super interesting and also comparably cheap instrument for your financing activities. I mean, of course, you wouldn't finance your whole balance sheet with this instrument, but as a nice mix, it's super interesting also for very large, very well rated suppliers. And we see many programs where also the suppliers might even have a better credit rating than the customers, as an example, and they are still using this instrument because of the before mentioned reasons. Yeah, it's off balance and it saves credit capacity of the supplier and all these things. So it's not only meant for weak suppliers. You can really use this instrument for the whole supply chain.
Oliver is thinking.
Yeah, maybe to add there, for example, I know from one of the major chocolate manufacturers, it's not Nestle, but is that, you can ask your suppliers, and it's almost, I would say, almost all your major suppliers in any organizations have already experience with being part of the supply chain finance program. So coming back to this chocolate manufacturer, I spoke a few years ago, they were part of 10 different programs as a supplier. So and they were massive, large, well-rated companies. So these companies are using is part of their toolbox in terms of cash management, working capital improvements. And I would say mainly these are the large, well-rated companies which are using it and as an additional tool to improve their liquidity and be flexible.
Oh, indeed.
Yeah.
I don't know if we have more questions, but we still have 1 minute.
I have, a question about how much does it cost? So this, maybe I can answer that from our perspective. How we price the data analytics part is very simple. It's an annual subscription, because obviously you're not negotiating payment terms in one day. It takes some time. So it's an annual subscription. It starts at a few $1,000s, and depending on the size of the opportunity which is analyzed, and you then have access to multiple users in the organization, and it allows you to upload almost all your suppliers to read and see what is achievable and simulate these type of financing solutions. I know Daniel,
Yeah.
Pierre, you want to
just like
explain?
very briefly from our perspective, so being conscious of the time, our main driver or the kind of main revenue driver is really a transaction fee, which is some basis points on top of the financing rate of the financing partners in such a program. I mean, reality is that compared to single bank programs, we are always achieving that our programs, given the competition between banks, is more attractive than again single bank setups. But this is really the main cost for corporate, which is then also paid by the supplier in the end in supply chain finance.
I guess very quickly from the advisory side, it will really depend on the size of the company and the complexity. And for client side consulting work, it's really also dependent on the size of your team and how much resources need to support you in that journey and how much support you would like, right? So it's really on the bespoke pricing, I would say. I'm just conscious of time, and I don't want to overrun because maybe people may have to leave. And if we have more questions, we'll be happy to follow up separately on them. But just as conclusions, I think we discussed a lot about data, machine learning, and comparison of the payment terms. Now is really the time for treasurers to go out and start working capital initiatives. We focused on supply chain finance here today. But the only thing I would like to say is that we want, first of all, to thank you to attend this webinar, but also we are more than happy to have follow-up discussions on everything that has been said today and more. We're happy to share more details on all the examples we presented. And also, as Oliver mentioned, we are also happy to share the sources, right, of the trends and everything we mentioned here today. So I'd like to thank you all for this time, and we will follow up on the remaining open questions.
Perfect. No, thank you, Pierre-Louis, for this great webinar.
Was
Thank you. It was a pleasure.
fun, guys.
Really nice.
Bye-bye.
Thank you. Bye-bye.